Hi everybody, so back to the question, explaining the matters that should be considered to determine if we are liable or not to fraud. So, in terms of being liable in terms of fraud, I think straight away, in the answer I'd put, look, auditor is not responsible for detecting fraud. Okay. What we have to do is just simply give reasonable assurance that the financial statements are free from material misstatement caused by fraud or error. Okay, and that you could actually say, remember, it's the management responsibility to detect and prevent fraud. So I think that's the first thing that we'd say, and overall, when it's, are we liable for fraud? Well, it depends what our responsibilities are. That's not the end of the question, though. So let's have a look. It said, the audit report on financial statements of Spaniel Co., a long-standing audit client, there's some words that she'd now need to tell us. Why did she tell us that? For the year ended 31st of December 12, was issued in April 13 and was unmodified, so all okay. In May 2013, so just a month later, the audit committee contacted the audit engagement partner to discuss a fraud that has been discovered. The company's internal auditors estimated that 4.5 million has been stolen. Now, when you're given a figure like that, you want to look at material misstatements. So this is part, we should have reasonable assurance that it's free from material misstatements. So first of all, we need to check materiality. He's given me a number, so let's check materiality. So materiality then is 4.5 million. Is the fraud, okay, and then does it give me any other figures? And it says the total assets were 80 million. So there you go, 4.5 over 80 million. That comes to around 5.6%. And so you'd say, therefore, this is material, and therefore, really, we should have detected it. It's not looking good. We should have detected it. But I think always what you say about fraud is, when it comes to this, you always put, however, fraud is difficult to detect. So we might not be negligent because it really is difficult to detect. Why is it difficult to detect? Because it's being deliberate, isn't it? It's deliberately hidden. Use of false documents, that sort of thing. So therefore, we might have actually done our job. We might have given reasonable assurance. We don't check everything. We might have followed ISAs and everything might be okay. So we're still not entirely liable yet. Let's keep reading. The audit engagement partner commented that neither tests of controls nor substantive audit procedures were conducted on payroll. Okay, that's not good, is it? As in previous years' audits, there were no deficiencies found in controls. So, you then go on to say, look, no tests of control. Okay, which is okay if previous year was fine. And if previous year is fine and management state that there's been no changes. There's no mention of that. Okay, but we should always perform on a material section. We should always perform some substantive tests. Okay, comes back to the question, why didn't we? And that's when I start to think that I now know why she told me it was a long-standing client. That's probably why we didn't, because it's a long-standing client. And when you have a long-standing client, the problem is you start to become reliant on them. You start to trust them a bit more. We lose professional, what's the word I'm going to use, skepticism. And if we lose that professional skepticism and we start not doing things we should do, then it could have a serious effect. We could become liable for being negligent. Okay, so let's just keep on going. Spaniel is considering suing Groom for the total amount of cash stolen from the company, claiming the audit firm was negligent. So the final bit of this question, you say, well, to be negligent, you always work through these three things. First of all, you need a duty of care. Secondly, you need to have breached that duty of care. And thirdly, the people suing you need to have had a financial loss caused directly by it. So let's have a look at this in detail then. Let's have a look at duty of care. We have a contract with the shareholders as a body, not as individual shareholders. As a body, though, we do, and they are suing us as a body. They are suing us as Spaniel Co. And we do. So to their shareholders, it's automatic. Not to the individual ones, but as a body, we do. We have an automatic duty of care. Did we breach that duty of care? Yes, we did. How would we prove that, no, we carried out our duty of care? Well, we prove it by adhering to ISAs. But they weren't, were they? ISAs not adhered to. E.g., no substantive testing on a material item. No testing at the assertion level. So, and then finally, the financial loss. Has a financial loss occurred? Yes, it has. The amount stolen. And so I think you would then just conclude that, yes, you would probably be negligent. You've gone through it all. And I just wanted to state right at the end, not part of your answer, that's it, your answer's done, saying that you probably are negligent. But I just wanted to mention something the examiner mentioned. And she said, with little application to the scenario, so i.e. if you don't use the scenario, there's limited scope for marks to be awarded. So what she's saying is, look, if you'd only just done this bit and not really talked about much else, just textbook knowledge, you'd have failed. What you need to do is use the scenario to answer those bits, but look all up here. Look how we use the scenario, all the way through how I was led by the scenario. So I'm using my knowledge, but I'm letting the scenario lead me. And that is the key to P7.